What if I told you there's an investment that Warren Buffett recommends, that beginner investors love, and that even financial experts put their own money into? It's not some secret strategy or complicated trading technique. It's something called an ETF, and if you've been confused about what they actually are, you're in the right place. Let's dive in. So, ETF stands for Exchange Traded Fund. Let me break that down in plain English because it's simpler than it sounds. Imagine you want to invest in the stock market, but you don't want to put all your eggs in one basket. You want to own a piece of Apple, Microsoft, Amazon, Google, and maybe 100 other companies. But buying shares of all those companies individually would be expensive, time-consuming, and honestly a headache, right? That's where an ETF comes in. An ETF is basically a basket or collection of different investments bundled together into one package. When you buy one share of an ETF, you're actually buying tiny pieces of all the investments inside that basket. Think of it like a smoothie. Instead of eating a banana, strawberries, blueberries, and spinach separately, you blend them all together into one drink. An ETF blends different stocks, bonds, or other assets together into one investment that you can buy with a single click. Now, here's the exchange-traded part. ETFs trade on stock exchanges, just like individual stocks. This means you can buy and sell them throughout the trading day at current market prices, just like you would with shares of Apple or Tesla. You log into your brokerage account, place an order, and boom, you own it. Let me give you a real example. The most popular ETF in the world is called SPY, and it tracks the S&P 500 index. When you buy one share of SPY, you're essentially buying a tiny slice of all 500 of the largest companies in America. One purchase, instant diversification across 500 companies. That's the incredible power of ETFs. ETFs versus individual stocks. When you buy an individual stock, you're betting on one company. If that company does well, fantastic. If it tanks, your investment tanks with it. All your eggs, one basket. With an ETF, you're spreading your risk across dozens, hundreds, or even thousands of companies. If one company in the ETF fails, it barely affects your overall investment because you own so many others. It's built-in diversification. Individual stocks are riskier, but can have higher rewards if you pick winners. ETFs are more stable and diversified, but your gains are averaged across all the holdings. You won't hit a home run, but you're much less likely to strike out. ETFs versus mutual funds. Here's where it gets really interesting because ETFs and mutual funds are actually quite similar. Both are baskets of investments managed as one unit. But the differences matter. First, trading flexibility. Mutual funds can only be bought or sold once per day after the market closes, and you get whatever price is calculated at the end of that day. ETFs trade throughout the day like stocks, so you can buy and sell whenever the market is open and you know exactly what price you're getting. Second, and this is huge, fees. Mutual funds often have higher expense ratios. Those are the annual fees you pay just to own them. Many also have sales loads, which are basically commissions you pay to buy or sell, sometimes 5% or more. ETFs typically have much lower expense ratios, often under 0.1%, and no loads. Over decades of investing, those lower fees can save you literally tens of thousands of dollars. Third, minimums. Many mutual funds require minimum investments, sometimes thousands of dollars to start. Most ETFs have no minimum beyond the price of one share, and with fractional shares now available at most brokers, you can start with even less. Fourth, tax efficiency. Without getting too deep in the weeds here, ETFs are generally more tax efficient than mutual funds because of how they're structured. This means you potentially keep more of your returns instead of paying Uncle Sam. So in most cases, for most investors, especially beginners, ETFs are simply the better choice. Lower fees, more flexibility, easier to start, better tax treatment. That's why they've absolutely exploded in popularity over the past decade. Stock ETFs. These are the most common and what most people think of when they hear ETF. They hold baskets of stocks and can be broken down further. Broad market ETFs track entire markets like VTI, which holds basically every publicly traded stock in the US market. Index ETFs track specific indexes like the S&P 500. Popular ones include VOO and SPY. Sector ETFs focus on specific industries like technology, healthcare, or energy. For example, XLK focuses on tech stocks. International ETFs invest in stocks from other countries or regions. VXUS covers international markets outside the US. Bond ETFs. These hold bonds instead of stocks. They're generally less risky and provide more stable, predictable returns. AGG tracks the total US bond market, while TLT focuses on long-term treasury bonds. These are great for more conservative investors. Commodity ETFs. These track commodities like gold, silver, or oil. GLD tracks gold prices. SLV tracks silver. These can be good for diversification but tend to be more volatile. Real estate ETFs, also called REITETFs, these invest in real estate investment trusts. You're essentially investing in property without having to buy actual buildings. VNQ is the most popular example. Thematic or strategy ETFs. These focus on specific themes or investment strategies. There are ETFs for clean energy, artificial intelligence, robotics, or dividend growth. These are more specialized and sometimes riskier. The beauty of having all these options is that you can mix and match different types of ETFs to create a customized portfolio that matches your specific goals. So now you understand what ETFs are, how they compare to other investments, and the different types available. But here's what we haven't covered yet. Why are ETFs so popular? What are the actual advantages? Are there any downsides you should know about? And most importantly, how do you actually choose the right ETF and start investing? That's exactly what we're covering in part 2 of this guide. I'm going to walk you through the specific advantages, the potential disadvantages, the exact criteria for choosing quality ETFs, and a step-by-step action plan for making your first investment. The link to part 2 is right here on screen and in the description below. Make sure you watch it, because that's where we get into the practical stuff. Before you click over, hit that subscribe button so you don't miss future investing content. Drop a comment and let me know. Did you already know what ETFs were, or was this your first time really understanding them? Thanks for watching. I'll see you in part 2. And if you can hit the like button, I would really appreciate it.